Have you ever wondered why you're not getting those big fat tax refunds? You know, the kind that lets you finally take that dream vacation or invest in that hot new stock? Well, here's the cold, hard truth. Most Canadians are overpaying their taxes every single year. But here's the good news. It's completely legal to pay less. You just need to know the right strategies. After working 12 years as a financial planner, and let me tell you, I've seen it all. And after hundreds of hours of studying this stuff, I'm here to share the top 6 things you need to know to pay less in taxes and keep more of your hard-earned money. To unlock the secrets to legally sheltering your hard-earned income from the taxman's greedy little paws. You don't want to miss this. Man in the dust. Now, for all you entrepreneurs and side hustlers out there, this chapter is for you. Being self-employed in Canada comes with a whole slew of tax advantages that can put more money back in your pocket. Think of it like this. When you're self-employed, you're not just an employee. You're the CEO of your own empire. And with that comes the power to deduct a whole bunch of business expenses that traditional employees can only dream of. First off, let's talk about business expenses. Everything from your home office to your marketing materials to your travel expenses can be deducted, lowering your taxable income. That's right, even that fancy new laptop you've been eyeing, write it off. Then there's the beauty of home office expenses. Working from your couch just got a whole lot sweeter. You can deduct a portion of your rent or mortgage interest, utilities, and even your internet bill. It's like getting a discount on your living expenses just for being your own boss. And let's not forget about the flexibility of EI and CPP contributions. As a self-employed individual, you get to choose how much you contribute, giving you more control over your cash flow and retirement savings. But remember, with great power comes great responsibility. Being self-employed also means staying organized, keeping accurate records, and understanding the nuances of self-employment taxes. Don't worry, I'm not going to leave you hanging. we're going to delve into all the juicy details like eligible business expenses, home office deduction rules, and the differences between EI and CPP for self-employed individuals. So get ready to unleash your inner entrepreneur and take control of your tax destiny. Now let's talk about those hidden treasures buried deep within the tax code. Tax deductions and credits. These are like little-known loopholes that can significantly reduce your taxable income and put more money back in your pocket. Think of it as a reward for being a responsible citizen. First up, we've got the childcare expense deduction. Raising kids is expensive, but the government understands that, and they offer a helping hand in the form of this valuable deduction. You can deduct a portion of your childcare expenses, like daycare fees or after-school programs, directly from your income, reducing your tax burden. Then there's the medical expense tax credit. We all know that healthcare costs can be a real pain, both literally and figuratively. But the good news is that you can claim a tax credit for eligible medical expenses, like prescription drugs, dental care, and even travel expenses related to medical treatment. And for all you generous Canadians out there, there's the donation tax credit. Giving back to your community not only feels good, but it can also save you money on your taxes. You can claim a tax credit for charitable donations, reducing your tax payable and making your generosity go even further. But these are just a few examples of the many tax deductions and credits available to Canadians. We're going to explore a whole bunch of other deductions like moving expenses, tuition fees, and even transit passes. So get ready to uncover these hidden treasures and watch your tax bill shrink before your very eyes. Now, let's talk about everyone's favorite four-letter word, real estate. Investing in real estate is not only a smart financial move, but it also comes with some sweet, sweet tax advantages. In Canada, we love our homeowners, and the government has created several tax breaks to help you build wealth through real estate. First and foremost, we have the holy grail of real estate tax benefits, the principal residence exemption. This beauty allows you to shelter the capital gains from the sale of your principal residence from capital gains tax. That's right, you can sell your home, make a profit, and not pay a single cent in taxes on that profit. But the benefits don't stop there. If you're renting out a property, you can also take advantage of rental income deductions. You can deduct expenses like mortgage interest, property taxes, insurance, and even repairs and maintenance, reducing your taxable rental income. And let's not forget about the power of claiming capital cost allowance or CCA on rental properties. This allows you to deduct a portion of the property's value each year to account for depreciation, further reducing your tax bill. But navigating the world of real estate taxes can be tricky. Don't worry, I'm here to guide you every step of the way. We're going to dive deep into the principal residence exemption, rental income deductions, CCA rules, and everything in between. So get ready to build your real estate empire and watch your wealth grow, all while keeping the tax man at bay. Now, we've covered a lot of ground today, from understanding the tax system to maximizing deductions and credits. But here's the thing, even with all the right strategies in place, you can still trip up if you're not careful. You see, the tax code is full of little traps and pitfalls that can trip up even the most seasoned taxpayer. But don't worry, I'm here to help you navigate these treacherous waters. One of the biggest mistakes people make is failing to keep proper records. Remember all those deductions and credits we talked about? Well, you need to be able to back them up with solid documentation. Receipts, invoices, bank statements. Keep everything organized and easily accessible in case the taxman comes knocking. Another common mistake is missing deadlines. Tax deadlines are like sharks. Miss one and you're gonna get bitten. Make sure you know when your taxes are due and file on time to avoid penalties and interest charges. And speaking of penalties, let's talk about another common mistake: underestimating your tax liability. It's better to err on the side of caution and overestimate your taxes than to get hit with a hefty tax bill you weren't expecting. We're going to cover all the common tax mistakes that Canadians make, from forgetting to claim medical expenses to incorrectly claiming the principal residence exemption. I'll give you the insider tips and tricks to avoid these pitfalls and keep your hard-earned money where it belongs, in your pocket. So pay close attention, because this information could save you thousands of dollars in taxes. So there you have it, folks. Those are my top 6 tax tips to help you keep more of your hard-earned money. Remember, knowledge is power, and when it comes to taxes, the more you know, the more you can save. Now, I know this might seem like a lot to digest, but trust me, it's worth it. Implementing even a few of these strategies can make a significant difference in your tax refunds. Don't let your hard-earned money go to waste. Start planning early, stay organized, and if you're ever unsure about something, don't hesitate to consult with a tax professional.